Investors have a long-standing obsession with the word safe. This comforts them, but it often leads them astray. Despite decades of observing the markets, I've seen the same pattern repeated endlessly. Those who pursue security without fully understanding it often find themselves at the greatest risk. True security in investing comes not from the label on an asset, but from thoughtfulness, knowledge, and discipline. Many retirees misunderstand this. They equate stability with security and believe that avoiding volatility in their portfolios will protect them. Cashing out their savings because the stock market appears risky isn't conservative. It's a slow surrender to inflation. Over time, purchasing power quietly but surely diminishes. The most important lesson from history, from the Great Depression to the post-war recoveries, is not that all risks are relentless, but that risk must be understood before it is assumed. Security in retirement isn't about avoiding action, it's about avoiding ruin. This distinction is often overlooked. Too many people chase high returns or buy assets they don't understand, thinking they're safe. Brokers, advertisements, and flashy brochures may label an investment as safe, but the true determinant of safety is understanding and rational decision-making. When retirees are no longer actively earning, their need for return can lead them to make irrational choices. When we look at human behavior, emotional needs are the most dangerous risk. A prudent retiree makes wise trade-offs. You can trade growth for stability, liquidity for higher returns, or simplicity for control, but you can't have it all. Graham's principle remains unchanged. Stay within your area of expertise. Understand what could go wrong, prepare, and make rational choices. This philosophy is the true foundation of long-term security, which is much more than chasing trends, fads, or popular assets. Now, let's consider the practical steps. For those approaching or already retired, a portfolio should prioritize resilience over excitement. Consistency, predictability, and rational allocation are the cornerstones of security. The goal isn't to beat the market, but to overcome your own potential mistakes. A structured and well-analyzed plan not only builds wealth, but also provides peace of mind. When building a retirement portfolio, the first priority is income stability. One of the most reliable sources of this is what I call permanent businesses, companies with a consistent track record of profitability, disciplined management, and long-term growth. They are like the dividend aristocrats of modern finance. The basic idea is simple. Own businesses that can weather economic storms and continue to regularly reward their shareholders. This isn't about glamour or thrill-seeking. It's about predictable cash flow and resilience. Then comes broad market exposure. For most retirees, trying to pick individual stocks is both risky and unnecessary. A diversified index fund, which represents the collective productivity of an economy, provides participation in growth while minimizing the need for speculative decision-making. Compound interest is the true process of building wealth, and this method allows the fund to operate quietly in the background. Trying to time the markets or chase hot sectors is rarely productive. Historical evidence shows that patient and consistent investing outperforms almost all short-term strategies. Liquidity is the third pillar. Short-term government bonds, money market instruments, or treasury bills allow retirees to react calmly during crises. While these instruments may not be intentionally exciting, their value lies in the optionality they provide. Retirees who cover several years of living expenses with liquid and secure instruments are less likely to make emotional mistakes during market downturns. Liquidity is a risk mitigator, not a yield generator. Fourth, a paid-off home provides a unique form of stability in financial markets. Eliminating debt transforms a fixed expense into a variable option, providing flexibility and independence. The ability to make decisions without external pressure in retirement is an invaluable asset in itself. A fully owned home reduces both financial and psychological vulnerability and provides peace of mind when external markets are volatile. Finally, the most important investment is the investment one makes in one's own self. A disciplined and logical mind is the ultimate compound interest machine. Understanding financial principles, continuing to learn, and maintaining intellectual rigor allows retirees to make decisions without being influenced by emotion. Markets will fluctuate, governments will adjust policies, interest rates will rise and fall. An individual who can remain rational in the face of chaos enjoys a level of security no product can provide. Graham always emphasized that intelligence alone is not enough. It is the combination of knowledge, discipline, and temperament that preserves wealth. The goal of these 5 fundamental principles is not to maximize return, but to protect against ruin. Income, growth, liquidity, shelter, and judgment together form a rational and enduring strategy. Retirees who respect these principles can navigate uncertainty without panic, avoid behavioral pitfalls, and maintain the dignity of financial independence throughout life's unpredictable events. One of the fundamental lessons of investing is that the greatest danger rarely comes from the market, but from ourselves. Retirees are particularly susceptible to predictable behavioral errors: greed, fear, impatience, and jealousy. Graham emphasized that even intelligent individuals can disrupt their fortunes by acting irrationally, often at the worst possible time. Understanding these pitfalls is as important as choosing the right assets. Greed is perhaps the most seductive trap. Investors see rising markets or popular sectors and convince themselves they've discovered a shortcut to wealth. They leverage, chase returns, or speculate beyond their comprehension. In doing so, they transform a safe portfolio into a high-risk endeavor. Graham's principle was clear: enough. Chasing excessive returns often leads to losses. A modest, sensible gain over centuries compounds far more reliably than high-risk speculation. Fear disguised as caution is equally dangerous. During market downturns, retirees often liquidate their long-term investments to protect themselves. The result is rarely protection. It is the surrender of a potential recovery compounded over years. Cash accumulated in panic quietly, but steadily loses its purchasing power. Rational investors prevent panic by maintaining liquidity and investing within their sphere of expertise. Fear must be controlled. Impatience and envy are equally corrosive. Impatience encourages frequent buying and selling, trying to time unpredictable markets. Envy encourages retirees to abandon disciplined portfolios and invest in the hot investments their neighbors brag about. Both erode long-term returns and emotional stability. Graham taught that consistency, patience, and adherence to simple, logical principles are almost invariably more effective than short-term acumen. Ignorance, often disguised as complexity, is an insidious but deadly trap. Investors use complex products and financial jargon to feel knowledgeable without understanding the underlying risks. Complexity does not create security. It often hides danger even from the investor himself. Graham emphasized that one should avoid investments they don't understand, no matter how attractive they may seem. Knowledge, clarity, and simplicity are the foundations of lasting wealth. Ultimately, a successful retiree is one who controls their behavior. Markets, recessions, inflation, and policy changes cannot be controlled. Human behavior cannot. By combining disciplined assets, dividend-paying businesses, broad index funds, liquid instruments, and a paid-off home, with sound judgment, retirees can withstand shocks and continue to grow their wealth safely. According to Graham, security is not a product, but a way of life. It is cultivated through rationality, patience, and an understanding of arithmetic limits. A retiree cannot eliminate all risk, but they can eliminate unnecessary risks through careful analysis, disciplined behavior, and avoiding speculation. True security is the product of resilience and temperament, not the allure of guaranteed returns. The philosophy is simple. Own sustainable, cash-generating businesses. Diversify across broad markets through index funds. Maintain sufficient liquidity to act calmly. Provide a personal haven to reduce dependency and risk. Invest consistently in your judgment. By adhering to these principles, a retiree is protected not only from external shocks, but also from their own emotional impulses. Graham reminds us that a portfolio is only as safe as the mind that manages it. Knowledge without discipline, assets without rational allocation, or patience without structure are all incomplete. The greatest security lies in a rational, educated, and calm investor. With these principles, retirees can face the future with confidence. They need not seek excitement, fear the unknown, or envy the fortunes of others. They survive and thrive not through foresight, but through preparation, common sense, and patience. Wealth endures when human stupidity is minimized and wisdom multiplied. Understanding the principles isn't enough. Many fail in their application. Graham emphasized that a portfolio should reflect common sense and temperament, not speculation or the latest trends. Retirees should create a framework that prioritizes stability, income, and optionality over grandeur and extravagance. 1. Dividend-paying companies. Dividend aristocrats, companies that have made consistent payments for decades, form the backbone of retirement income. While they may not be the most ostentatious investments, their reliability ensures a steady cash flow. Retirees can reinvest their dividends during the growth years and withdraw their principal in retirement without touching it. Consistency is key. Decades of disciplined payments demonstrate resilience through every market cycle. A well-chosen core stock protects both wealth and sanity. 2. Broad market index funds. Index funds are the simplest way to hedge against risk in the productive economy. Retirees avoid the risks of individual stock selection by owning a portion of each company in a major index. Market declines are possible, but history shows that patience, built over time, is more important than short-term acumen. Low-cost index funds reduce prices, simplify management, and offer exposure to growth without requiring constant intervention. 3. Short-term treasury bonds and cash equivalents. Liquidity is the unsung hero of safety. Treasury bonds and other cash equivalents act as a buffer against panic-driven decisions. They are the oxygen of reason. Without them, even disciplined investors can be forced into premature sales. Graham argues that holding 2 to 3 years' worth of expenses in liquid, risk-free instruments is a strategy, not a fear. It maintains control and avoids selling investments at a loss out of desperation. 4. A paid-off home. Owning your home outright provides peace of mind unparalleled in the financial markets. It eliminates mortgage payments, the largest recurring expense, and provides psychological support for retirees. A debt-free home eliminates dependence on leverage, reduces stress during periods of volatility, and provides flexibility in retirement decisions. Graham's philosophy prioritizes security and simplicity over speculative gain. 5. The investor's mind. Finally, the ultimate investment is the mind itself. Judgment, patience, and understanding become synonymous with time. Retirees who continue to learn, evaluate, and apply rational thought protect their portfolios from emotional pitfalls. Graham realized that even the best structured portfolio cannot withstand irrational behavior. Constant intellectual engagement allows investors to weather market cycles without succumbing to panic, jealousy, or overconfidence. The genius of Graham's approach lies not only in individual asset selection, but also in how these assets work together. A rational portfolio balances income, liquidity, and independence. It is structured to withstand volatility, prevent emotional reactions, and allow compound interest to work quietly. 40 to 50% in broad market index funds for long-term growth. 20 to 25% in dividend-paying companies for stable income. 10 to 15% liquidity in short-term treasury bonds. The remainder is in a paid-off home and cash reserves. Continuously invest in your mind and intellect to maintain rational decision-making. This framework reflects resilience over excitement, discipline over speculation, and clarity over complexity. Graham's timeless advice reminds us that the safest retirements are built not on guesswork, but on preparation, patience, analysis, and rational allocation. Even with the right assets, retirees face one final risk: themselves. Emotional reactions to market fluctuations, fear-driven decisions, and envy of others' perceived gains can undo decades of prudent planning. Graham emphasized the importance of self-awareness. Avoiding the traps of greed, fear, impatience, ignorance, and envy is essential. A rational investor survives market chaos because they can address their impulses, not the uncontrollable forces of the economy. True financial security is not a number on a statement or a product sold by brokerage firms. It is the byproduct of disciplined thought and rational action. Graham's philosophy teaches that retirees achieve security through patience, preparation, and intellectual rigor. The right assets, combined with the right mindset, create a structure resilient to recessions, inflation, and human folly. Security is simple, but not easy. It's achieved by avoiding foolishness, acting with understanding, and maintaining moderation. Retirees who embrace these principles can live carefree, knowing that their wealth and independence are protected not by chance, but by a rational principle. Now that we've examined the philosophy and assets, let's translate them into practical steps that any retiree or someone nearing retirement can implement immediately. Graham always emphasized practical wisdom, not abstract theory. Step 1. Audit your current portfolio. Before making any new investments, understand what you already own. Identify which assets provide reliable income, which are high risk, and which may be illiquid. Retirees often unknowingly hold assets that destabilize their stability. Ask yourself, does this asset provide predictable cash flow? Do I fully understand the risks? Could a market downturn force me to sell at a loss? Clarity in assessment is the first step in rational decision-making. Step 2. Allocate based on temperament, not hype. Graham said that investing is based more on psychology than mechanics. Allocate your portfolio based on your risk tolerance and need for stability, not on what a broker or expert recommends as a popular asset. A suggested framework: 40 to 50% in broad market index funds for long-term growth, 20 to 25% in dividend-paying companies for reliable income, 10 to 15% in short-term treasury bonds or cash equivalents. Constantly investing in your own mind for sound judgment. This framework emphasizes resilience over excitement and acts as a shield against behavioral errors. Step 3. Focus on consistency, not maximum return. Seemingly exciting investments often conceal hidden risks. Graham taught that the greatest danger comes not from the market itself, but from self-deception. A portfolio that consistently multiplies wealth, even when it's boring, outperforms for decades. Reinvest dividends, avoid chasing market trends, and let compound interest work quietly in the background. Step 4. Maintain liquidity and options. Short-term treasury bonds, cash reserves, and a paid-off home act as a buffer against panic. They provide freedom of movement during market turbulence. Never underestimate the power of liquidity. It allows you to remain calm, resist emotional decisions, and seize opportunities while others sell out of fear. Step 5. Maintain your mind, the most important asset. Financial wisdom, like capital, accumulates. Retirees should continue to learn, observe, and refine their judgment. Read annual reports, study the markets, understand human behavior, and become aware of your own emotional biases. Graham emphasized that intellectual discipline is the most enduring form of protection. If your decisions are based on rational thought, no market crash can harm you. Step 6. Avoid predictable behavioral traps. 5 human behaviors consistently destroy wealth. Greed, pursuing returns at the expense of stability. Fear, selling during market corrections. Jealousy, abandoning discipline in response to what others are doing. Impatience, overtrading and reacting to noise. Ignorance, buying complex instruments without understanding them. By recognizing and mitigating these tendencies, retirees protect not only their money but also their peace of mind. Step 7. Embrace simplicity. Graham's final advice: preserving wealth is often simple, but it requires discipline. Reduce unnecessary complexity and focus on assets you understand. True security comes from structure, not complexity. Final thought: security as a philosophy. Before 2026, successful retirees will not rely on luck or speculation. They will rely on a rational, patient, and disciplined approach. Security isn't a product you buy, it's a life you build. A portfolio that combines dividends, index funds, liquidity, a paid-off home, and a constantly active mind ensures wealth lasts. Remember Graham's guiding principle: avoid foolishness, act with understanding, and let time and discipline build your advantage. Those who live by this principle not only survive market cycles, but also live freely, confidently, and with dignity.